By late June of 2026, the broader cryptocurrency market was completely locked in a steady, unyielding downward slide. As the calendar flipped into the third quarter, Bitcoin tumbled to a 21-month low. Selling pressure seemed entirely in control, stripping away months of previous gains. The drawdowns were even steeper across the broader digital asset landscape. Major altcoins faced relentless daily haircuts that pushed portfolios deeper into the red. Market sentiment matched the price action. Retail traders and institutional desks alike were actively bracing for a continued, widespread collapse across the entire sector. Then, over the long July 4th holiday weekend, the market's direction violently snapped. This chart maps Bitcoin's sudden explosion back above $63,000, erasing June's heavy losses in 5 sessions. The collateral effect was immediate. XRP surged 10%, pushing its market value to $73 billion and overtaking the USDC stablecoin to become the world's 5th largest cryptocurrency. Double-digit weekly gains flashed across the board. Ether jumped past $1,793, while Solana firmly held near $82.50. The transition from a historic slump to a euphoric rally is a product of the specific, volatile math found in an empty market. This momentum shift originated within the realm of traditional macroeconomic data. Federal Reserve Chair Kevin Warsh publicly noted that domestic inflation risks were finally beginning to come down. Immediately alongside that, the Department of Labor released a surprisingly soft June jobs report, confirming that the broader economy was indeed cooling off. Bearish crypto traders had been actively pricing in a highly restrictive, high-interest environment. Suddenly, the domestic data suggested a noticeably friendlier economic backdrop. This unexpected dose of optimism from traditional finance provided the initial buying pressure necessary to disrupt the established downward momentum. Before the macro shift hit, the crypto market was heavily saturated with short sellers betting on lower prices. This heat map visualizes XRP's washed-out positioning, with holders at their deepest average losses on record. Panic selling is exhausted, turning the market into a tightly coiled spring. Trapped short sellers are then mechanically forced to buy, violently accelerating prices in a short squeeze. The July 4th rally was a mechanical event, fueled by trapped bears covering their tracks to avoid liquidation. The timing of the rally over the Independence Day weekend provided a structural amplifier. Because this played out over the holiday, traditional U.S. markets were completely shut down. Institutional trading desks and major market makers were offline. This order book during the holiday window shows thin liquidity. Active buy and sell orders are drastically reduced. In this empty environment, the wave of forced short squeeze buying meets virtually zero resistance, effortlessly sweeping through price levels and spiking the charts instantly. The holiday vacuum acted as a structural multiplier. Upward price actions that would typically be absorbed and flattened out in a normal trading week were allowed to run wild. A macro spark, a short squeeze, and thin holiday liquidity successfully combined to put Bitcoin back on solid footing for the third quarter. But because this $63,000 recovery was mathematically amplified by holiday quirks, the recovery's foundation remains untested. The true test of this momentum will arrive when vacationing U.S. institutional trading desks finally return to their terminals and restore standard market liquidity. At that point, the impending U.S. inflation print will serve as the next catalyst to dictate the market's midterm direction. A sudden price surge is rarely proof of an asset's underlying value. Often, it is simply an illusion created by the temporary mechanics of market structure.